The volatile and unpredictable market has investors realizing they can't rely on their tried and true strategies. Cambria Investment Management CIO and co-founder Meb Faber is here with his take on where the market is headed next. Meb, thanks for coming on the show.
Great to be here.
So let's start with the news at the end of the week. What's the takeaway for investors from Silicon Valley Bank's implosion, and do you expect contagion?
I think the first thing, if you're a bank depositor, is don't put all your eggs in one basket. So you want to spread that out. I don't expect contagion because the story is actually really simple, and it's a story as old as time, which is a bank, and you could substitute the word hedge fund or anything else, made a very specific bet, and their bet was they invested a lot in investments that would do very poorly if yields went up. And that's what happened. It's actually pretty simple. And this happens to a lot of investors. You could substitute bonds for real estate or commodities or stocks or whatever it may be. But when people have an investment and don't cover all the possible, even if improbable, right tail, left tail sort of events, they can get into trouble, and not just a little bit of trouble, catastrophic trouble.
We've certainly heard that story before. I want to go back to May of last year. You were on this show with my colleague Jack Howe, and you accurately predicted that the market had farther to fall. What is your crystal ball telling you now?
Well, I'm going to give you the bad news first, then the good news, okay? U.S. stocks are still expensive. And this is broad market cap weighted S&P style. We like to use the 10-year price to earnings ratio is up around 30. Now, it's not as high as it was at the peak of the cycle, around 40, but over time, the average is around 18 to 22. So we're still high. The problem comes if inflation hangs around, the average isn't 18 to 22, it's about 12. Okay, and 12 is a long way from 30. Now, that's the bad news. So the broad U.S. market is still vulnerable. The good news is it's one of the best times in history to invest in value stocks. And if you look at the spread between the cheap stuff, we like to use the term shareholder yield, meaning companies that pay out dividends and buybacks, have a lot of cash flows, and are trading cheap values. These are some of the biggest spreads we've ever seen in the United States, and also some of the biggest spreads in foreign developed and foreign emerging too. So it's like two sides of the same coin. The bad news is broad market, problematic. The good news is lots of places we think you can hide out.
So value looked cheap against growth for a long time. Same could be said for foreign and emerging. Starting with value, what changed that makes you think this really is the big switch we've all been looking for?
I think the regime shifted in 2020, which was the interest rate bottom as well as inflation bottom. I mean, it wasn't that long ago. It was like half the sovereigns in the world had negative years. Gone are those days, okay? So interest rates have been running up. And then I think we also had a second inflection point, which was the end of last year, which was the peak in the U.S. dollar. The U.S. dollar is about 20% overvalued versus foreign currencies. So you have this potential double tailwind. And if it's a triple tailwind of high expected inflation to continue, you have all three of these things happening at the same time. This should be wonderful for value stocks like the 1970s, 1940s, but also for foreign developed and my favorite, emerging markets, deep value as well.
So with emerging, you've got the tailwind of the falling dollar. There's been, of course, great growth in those countries, but growth doesn't seem to necessarily be correlated with good stock market performance. Can you break that down? Is it just that they're so cheap, they're destined to do well?
You always got to separate the business or the company from the stock. I mean, great example, Cisco in '99, right? The business grew for another decade. It was wonderful, and the stock went nowhere. But if you look back at a lot of these foreign country stock markets for the past 10, 20, 30 years, many of them have gone nowhere. And even nowhere, they've gone down. So you're talking about single-digit PE ratios, high single-digit dividend yields. On top of that, they're buying back stock. They have great cash flows and growth. All of these are wonderful signs. Now, the timing, who knows? Maybe the U.S. will continue to outperform. But on average, we think it's one of the best bets you can make. And over time, by the way, foreign stocks versus U.S. stocks is a coin flip, right? Over time, which one outperforms any given year? We just finished one of the longest periods of U.S. stock dominance. We love U.S. stocks, but on average, almost half the world is outside of our shores.
Well, that is great advice because most investors, of course, are way overweighted in the U.S., so even just getting back to even could be a good play. Meb Faber, thanks so much for coming on the show.
Great to be here.